Home ownership has long been the Australian dream, and residential property investment has had a stellar run over the past few decades. But as we all know, bricks and mortar can throw up some challenges, including liquidity. One way to get exposure without the ownership hassle is through mortgage funds. I spoke with Paul Miron from Msquared Capital and started by asking him about the basics. What is private credit?
It's a great question. So private credit is a very vast area as well. It can cover many different types of debt instruments. So for example, you can have a loan against a construction site. You can have a loan against a small business. It can be secured against property. It might be unsecured. It can be in the bond area, and you can even go up to sovereign debt. So private credit covers a vast variety of different types of debt instruments. So the difference is Msquared Capital focuses on direct loans which are secured by property.
Right. Okay. So it's the almost like years ago they had the old solicitors' loans, didn't they, that people could invest in through your account of a solicitor. There's a similar sort of concept, but on a much bigger scale.
Absolutely. So from those early days, the debt is a concept that has been around for hundreds, maybe even from the thousands of years as well. And the concept is very simple. You have money. You have money. I want money. I need money, and you borrow the facility. Now it's much more sophisticated now than the solicitors' funds because we run a fund structure. We source the opportunities. We manage the transactions as well. And we look at the risk and reward very, very carefully so that our investors get those benefits from that.
And for a borrower, instead of going to a traditional financial institution, they get credit through this area, which is basically matching investors up with borrowers, isn't it, directly?
Precisely.
So what sort of role should private credit play in an investor's portfolio?
Well, it has a significant role because if you look at private credit and the nature of it, where do you sit from a risk perspective? So you sit on a debt perspective. So irrespective of what's happening in the market volatility. So I was in the green room just now and listening to one of the interviews. Well, a lot of people right now are really worried about how the large corporations right now or any business deal with a margin squeeze because you've got high interest rates for a lot longer. Profit margins are being decreased. So right now, a lot of people are thinking about, where do I want to sit? Do I want to sit on the equity side or I want to sit on the debt side? On the debt side, you get priority. You get paid first before anything else. So the benefit in someone's portfolio is that you have that consistency, regularity of income. So over a long period of time, someone's portfolio can actually outperform.
And it's secured against real assets, as you say.
That's right.
Which, when you're in a high-risk environment, it forms part of your low-risk foundation to your portfolio.
Yeah, it also adds medium and sort of medium liquidity as well. So right now it's a high possible volatile market, and you have very astute investors move more of their portfolio into private credit because the asset preservation quality and that consistent income as well. So it forms a great avenue to decrease the risk.
And all the focus is on interest rates at the moment and income returns in your portfolio, how to maximise it. How does this manage that side of your income, the income side of your portfolio better?
Well, it's with us, with Msquared Capital, it's all about giving the investors the choice to be able to create their own portfolio. As I said, there's a lot of variety in relation to it. So you can actually have a single asset investment where you want to have maximum transparency. You want to see, you're investing in a specific mortgage. It might be from a 6-month term to a 3-year term. You might choose it based on the asset class, the quality of borrower, but each one is risk rated. And we have 2 pooled funds that they're having. One of them has a double-digit return. The other one is a very conservative one that has no exposure to construction or development, which is a very topical subject at the moment as well in relation to the heightened level of risk in that particular segment.
And as you say, private credit generally can be either secured against property or can be in bonds, can be in corporate bonds,
That's
government
right.
bonds.
That's right.
The alternatives are quite wide and varied, aren't they, to suit your own particular needs?
Precisely. And it's really up to the investor to actually understand and do their own research to work out what the risk and reward is. So, for example, 18 months ago, our investors came to us and said, look, for the extra 1% return in investing into a mortgage against a construction facility, it's just not worth it. So we actually developed a pooled fund that has no exposure to construction, no specialized security at all. The average gearing, which is a weighted average against all of the mortgages in that portfolio, is under 50%. So that actually offers the investor to be able to choose what type of risk they want to have. That particular fund is offering 7.75% last month. So that is probably the lowest spectrum of risk when you're dealing with private credit or direct private credit loans.
Which is still over 7% return.
Precisely.
When a lot of private investors would be saying, term deposits are nowhere near that at the moment. Dividend yields on stocks, some of them can be pretty attractive, but then there is the issue, can they be maintained in an environment like this going forward? Because there's so much uncertainty. So it brings consistency to your income return, doesn't it?
Absolutely. Look, Albert Einstein said that compound interest should be the eighth wonder of the world, only because if you look at it from a mathematical perspective, you want to be having absolute returns every single year. And that enables your portfolio to grow. And also, a lot of people in private credit, a lot of our investors, they live off that particular income. Yep. It is if you're living off that income, you need it to make sure that it's asset preservation, it's regular, and you know every single month that you're going to have on a particular day, you know exactly how much money you're going to have in your bank account.
Okay, so let's go through the M-Squared portfolios and products that you've got at the moment. Just run through the first one.
So the first one is a single asset opportunity. Right. So for example, we have a number of different investors. They give us a mandate. They're also on our investor base as well. We have a big list of active investors. Someone who comes to us has a requirement to borrow money. We package it together. We put a due diligence pack for that particular opportunity, a separate IM. So your exposure is only to that particular one opportunity.
Right. And it's one property. Give us an example.
A great example. So we had a very well-known architect who called me up and said, Paul, I've got a big contract that it's taking them too long to pay me. I've got a property in Melbourne. It's unencumbered, meaning there's no mortgage against it. It's worth 1.5 mil. I need $500,000. So that particular scenario, it's a very low geared. He wouldn't necessarily be able to go to the bank because it'll take too long. He has very complicated financial structuring. We were able to put that together within a week. Investors received a return of around 8% for that. Right.
And what was the term of it?
The term was 6 months.
Right.
So, and we're finding right now, our investor base is saying, well, things are very, very volatile. We don't know where interest rates are going. So we're finding 12-month facilities is really where investors want to be. And so we're doing a lot of those opportunities at the moment. Okay. So the single asset fund allows you to choose your own transaction. Now, we have opportunities where we're paying up to 13%, but obviously that's up the risk curve as well and different scenarios.
Right. Now, you've got the mortgage income fund. That's Explain how that works.
Well, we have a pooled fund, and I think I mentioned it before. Yes. It's a first mortgage fund only, so you can only have first mortgages in it. It's a very conservative fund. So
you're first in line.
First in
line. If anything goes wrong with the property or the borrower.
That's right. So we have a mortgage or over a physical asset. It can be over, the security could be a residential property. Mostly we like residential at the moment because of the way the market is. So residential could be commercial, can be industrial, but 87% of that portfolio is in residential only. And the average gearing is 49% at the moment, but we have zero exposure to construction, land, farmland, or any specialized security. And the reason why we do that is that if things get tough, we want to make sure that the underlying security in event of default is liquid. So if you put it on the market, there's a larger pool of people who are wishing to buy it.
Right.
We can return the money very quickly.
Okay. Minimum investment?
Minimum investment is 100,000.
Right.
And we're a wholesale fund, so we're looking for sophisticated investors.
Okay, and liquidity?
Liquidity in the first year in the both pooled funds, the money is sort of locked up, but then we do quarterly withdrawals.
Right.
After
okay.
that.
All right. Now, and you've also got a high yield fund as well.
Precisely. So
how is that different?
Well, the high yield fund can do a little bit of construction, can do slightly different, some second mortgages, and the gearing on the deals that is in that particular fund is a little bit higher. And so that particular fund is returning 10.3%.
Right.
And the average gearing against all the portfolio is 65%. So it's still very, very conservative.
Average investment there and term?
And the same as
Same,
other.
100,000, 12 months
12
locked
months.
in, and then you can do quarterly withdrawals. And you're paid quarterly as well. The income is
You're paid
returned
monthly. So
monthly.
you're paid very important. I think the monthly paid is very critical. All of our investors love the monthly
On both
income.
of them?
On both of them.
Monthly
all
pay.
of our funds, every single one of them.
Okay. So cash flow is really important for a lot of investors, isn't it? So
Absolutely.
that monthly is important. Tell us about Msquared, your background.
Well, my personal background, I have had, I left uni and I had a banking career. I started a financial services business, which was an award-winning business. Myself and Paul Miliotis, we had competing businesses and we joined forces through our passion, and we saw a significant gap in the private credit space. You know, more than 8 years ago, when you would say private credit, most people look at you and go, what is that? So it's only become really popular now. But we saw a significant gap in the market. And the gap in the market is we were participating in private credit with our own money. And we thought there are so many other people who would love to have that opportunity, but it's never brought to them in that particular transparent way.
Yep.
So that's how Msquared got born.
Give us an outline of a typical investor.
We have investors of all walks of life. So we have self-managed super funds. We have charity organizations that come to us. You know, we have one particular investor that I'm thinking about. They give us a mandate of exactly what type of risk they want to have, what type of return they want to have. And after they give us a mandate, we actually choose between the three options how to put the whole portfolio together for them, depending on their requirement.
Right.
So, you know, I can give you another example. We had a charitable organization who said, Paul, we don't want any construction risk at all. We want it absolutely safe. We don't want to have any more exposure than 50%. So we put a whole portfolio together for them of all type of different mortgages that were under 50% gearing. And it works really, really well for them.